Hello and welcome to the Money Show, your go-to source for smart, practical and powerful financial talk. Whether you are trying to crush debt, build wealth or just get a handle on your money, you're in the right place. I'm Kavita Thapliyal and every week we break down the numbers, demystify the markets and give you the tools to take control of your financial future. So grab your coffee and your financial goals and let's talk money. And today we'll be focusing on your life financial planning also on the show. So just in case you want to send across your questions, you can do that on our WhatsApp number and email ID. WhatsApp number is 865-797-4571 and the email ID is themoneyshow@etnow.tv. All right, so let's begin now with the markets constantly shifting between highs and corrections and sector-specific performance turning increasingly unpredictable. Investors are left wondering where to place their bets. Now, in such uncertain times, flexibility can be your biggest asset, and that's exactly where Flexi Cap funds come in. These funds give your portfolio the freedom to move across market caps, large, mid, and small, based on where the best opportunity lies. So, in today's dynamic market conditions, could Flexi Cap funds offer the right balance of growth and risk management? Let's break it down. I have with me Sachin Relekar, Senior Equity Fund Manager, Axis Mutual Fund. Hi, Sachin. Good evening and welcome to the show. We'll be focusing on investing in flexi funds, but then flexi cap funds, where we've also seen, I think, as per the AMFI data, this was the straight 6th or the 7th month where we've seen strong inflows in this particular category. Thanks to the market volatility, there is a revived interest in flexi cap funds that we are seeing among investors. Before I talk about your fund house's flexi cap fund or Axis Mutual Fund flexi cap fund, I want to understand the kind of opportunity in a flexi cap fund that an investor has right now, considering the current market trajectory and movement. Sachin.
Sure. Thank you. Thank you for having us here. As you pointed out, FlexiCap basically gives you an opportunity to take advantage of various opportunities across the investment universe. It is market cap agnostic. I think that allows the flexibility to invest selectively across the different buckets as well as different sectors. And yes, there is a lot of uncertainty, as we can see, around the sectors, around the themes also, and globally also things are uncertain, and that's where actually the flexibility of the approach actually comes into the help. So this is a more, and most of the FlexiCap funds have a very diversified benchmark as well. Therefore, you can actually place yourself very selectively across the market cap buckets as well. So those are the very important aspects, which is what actually gives you the very balanced kind of positioning in the environment like this. But I will suggest it's not just about this kind of environment. Even from a medium to long term point of view, having more majority of your allocation towards the diversified funds actually helps you, because anyway diversified funds can take advantage of different opportunities in the market.
All right, Sachin, now let's talk about your fund and the exposure that you have in your Flexi Cap fund. So what's the exposure like across market caps?
So as of now, we are closer to two-thirds into the large cap and around 18-20% into mid caps, and about 6-7% into the small caps, and some amount of cash we are having. But that's not a major cash call as such. But this is the broadly the as of now how the market capitalization categorization goes. That's how we are.
What's the sector-specific exposure as far as your mid-cap and small-cap exposure is concerned?
See, in mid-cap and small-cap, those are very, very bottoms-up ideas. We are not laying overlaying sector approach over there. But broadly, we have a few specific investments into healthcare and real estate and some of the cap goods themes. Those are some of the broad counters of our mid and small-cap exposures.
Okay, and then what about large caps? Any specific sector-oriented approach that you've opted over here?
So this is not a sector-oriented approach, although we have looked at our benchmark composition per se, and in that you will find we are quite closer to benchmark in terms of the financial services exposure. Within that, majority of our exposure is actually towards the lenders only. We are not gone into the financial services per se. And followed by that, we have slightly closer to or slightly underweight kind of exposure into IT services, and we don't have much of exposure to the energy. So a lot of that energy underweight is actually where we are deployed into the sectors which are kind of smaller in percentage into the benchmark, likes of real estate, likes of cap goods, or likes of healthcare services. That's where slightly larger tilt is there. Also, we have a majority exposure which stands a little differentiated compared to the benchmark exposure is into the retail or consumer discretionary person.
Mhm. You know, when you talk about stock picking, now that is how I think the exposure in this particular fund is decided. What would be your key filters looking at the current market movement, you know, and what would be, being a fund manager, your priorities in terms of stock picking also?
Yeah, so we are, as I said in the beginning, we are much more focusing on the bottoms up approach to the investment. And starting with the credible management is where our first filter comes in. We give a lot of importance to the management aspect into picking the names for the fund. And therefore, the track record of the company, track record of the management, the quality, their approach to the capital allocation decisions is of a prime importance. Thereafter, of course, we are looking at the sustainability of the earnings and the long-term characteristics of that earning is what we focus upon. Followed by that, we are looking at companies which are actually kind of winning on the ground. So whether they are coming out of winner as in because of the industry consolidation per se, or there is a clear competitive advantage which the company has, and therefore they're getting more market share because of that. Those kind of things is what we are looking for. We are also focusing on very large kind of addressable market opportunity, and that gives the scalability of the business. So some of these things is what we actually focus upon. And finally, we are also looking at what kind of risk reward at the current valuation does this opportunity offers. So those are some of the broad aspects of the investment is what we focus upon. And if those companies are at an inflection point in terms of their business journey, for certain reasons where the kind of product cycle they are going through, which is leading to a very supernormal kind of a growth or a delta versus the industry growth for that particular name, is what actually we kind of build more concentration over there.
Mhm. Sachin, how has Axis Flexi Cap Fund managed downside risk historically during corrections? If you could just give us some data.
So, in terms of downside protection, again, we rely more on having a right quality of the business into the fund, because we believe even in the correction phase or in the volatile phase, I think market tend to give much more importance to the quality of the underlying quality of the business. And if it also has a stronger earning growth within an uncertain period, that's where actually these companies actually stand out compared to the market movement. So the focus on the quality and the underlying sustainability of the growth is where actually the risk management comes into the place. And I think that is the central aspect which we focus upon, and that's what it continues. So across the cycles or across the volatile phases also, that's what we look at. We also kind of look at whether the macro impact on the business is outsized or disproportionately high. If that is the case in certain environments where macros become unstable, the valuation does take a lot of impact because of that. So we kind of like to reduce exposures to certain names where the macro exposure is very high or the impact coming from the macro factors is kind of very high. That's where we kind of that's actually the risk mitigation approach which we adopt.
Can you share the fund's recent performance relative to its benchmark and peer groups?
Yeah, so if you actually look at peer group on a 1 year or in terms of the benchmark, I think we have created a meaningful alpha over there. But that is to do with what are the changes which you brought in over a period of time. It's more gradual process, and I'm referring to just about 1 year. But from a longer term point of view, also I think the changes and the approach which we are bringing in, I think that should help us in doing relatively better compared to the benchmark, and that is the approach. So we are more looking at the benchmark composition, what kind of opportunities which are available there, what are the approaches which we can take where we think the candidates or the constituents in the benchmark actually offers a better opportunity. That's where the tilt is going, and I think as a process, that's what we are following, and therefore I think we can, I mean, comfortably or confidently say that that should lead to this kind of incremental alpha which we are aiming to generate.
Sachin, I also want to understand, are you looking at or are you seeing more opportunities in mid cap and small cap at this point in time, or you think that large caps are going to be dominating, and maybe that is the philosophy of the fund, which is largely large cap focused or biased?
So we are not seeing that we are biased on the large cap. Basically, all that
Sure.
exposure is coming because of how we are seeing the opportunity over there. While the business quality and the earning are underpinning our entire approach, but at the same time, we are also looking at what kind of risk reward which is available there, and the risk reward and all the composition of both the aspects taken together, the opportunities are selected accordingly, and therefore even in mid and small cap, while the exposure is at as what I stated, there also we have taken a very selective approach. In fact, in one of the exposure which is very, I mean, if you look at in terms of the ranking, some of the exposures in the top 10 names also comes from mid and small caps. So not necessarily that we have placed our allocation more on the large caps only, and thereafter we have gone into search for mid and small cap. It's basically how the investment proposition are getting ranked in terms of the attractiveness from both the aspects of a business which we want to buy, at the same time what kind of a risk reward which is available. So it's very as I said, very framework driven kind of approach, and that's what led to this composition which we are having currently. And that
Sure.
actually will be also the ongoing approach for us. So we will keep looking at the entire universe which is available, and from the universe we'll keep selecting the names as per this framework which we are talking about.
I also want to understand the cash position right now. Did you earlier mention that you're not sitting on much of cash, and maybe that is the norm that you also practice across funds in the AMC? Is that right?
So it's not a cash call per se. We are not saying I want to remain in the cash for this percentage or any of those things, because this fund is meant for a long term, and therefore the cash call or the cash which is there is a resultant of how we want to be looking at businesses where perhaps either the price is not right or some of the things which we want to be clear about are just not clear as of now, and we're looking for certain events to unfold, and therefore that cash is waiting to be deployed. However, from a tactical point of view, for the ease of deployment, we will have certain amount of cash, about 4-5%. As of now, it is slightly more than that, but that is more to do with certain names where we either we are exited because of the reasons I mentioned about the risk mitigation, etc., where we thought the some of the exposures are too much sensitive to the macro impacts, and that's where we kind of reduce the exposure. And some of the exposures which we are waiting or looking to add on is where either we are waiting for the price or we are trying to understand it better, and that's where the cash is there. But certain amount of cash is more for the just ease of deployment. But there is no cash call per se, as in I will not say there's any thought process of having a cash call over here.
So, flexi cap in an investor portfolio can be used as a very nice strategy or a great strategy to give stability, looking at the large cap exposure in these kind of funds. I want to understand, these funds are actively managed. There's no doubt about it. We are talking to an active fund manager also. But then what role, according to you, does investor patience really play, when it comes to reaping returns? How can that actually enhance your returns, give it a boost if you are slightly patient and disciplined in your investments when it comes to a flexi cap fund, and why?
Oh, certainly, because it is about an equity fund. It is all about having a patience and a right time frame for the equity allocation. So if your profiles suggest to have a certain amount of equity exposure, then it also has to come with that longer term approach for that. So if you have a longer term approach, I think that is where you can tide over the volatile phase. Some of these uncertainties can be smoothened out over a period of time, and eventually, from a long term point of view, equities are more compounding, and that's where the real benefit of the equity investment will come. And I think the flexi cap strategy is actually meant to do or achieve that, because it's not tilted on cycles per se, or it's not having a market cap bucket approach as well. It is basically premised on very having the ranking or the selection based on the investment rationale per se, and therefore that discipline etc. will actually help you if you are a longer term investor, and that's where the real benefit of investing from the equity exposure will come.
All right, I think, Sachin, that will be all. Thank you so much for taking time out and talking to us about flexi cap funds and about the category in general. Thank you so much.
Thank you.